This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Tuesday, May the 7th, 2013. I'm Gord Long at GordonTLong.com. As usual, I have a lot of charts for us to go through this morning, so therefore I'll pass over some of them quickly and leave you to examine them further at your leisure. You'll need to open your slide viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our quarterly cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers that are actually behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and in the short term confidence and sentiment. In this regard, I want to talk today about first some economic indicators to give us the proper perspective. Goldman's swirlogram that I have shown many times before, the big three risks, and the quickly decaying U.S. macro indicator. Second, look at Q1 earnings, the revenue problem that is now evident, and the growing squeeze in margins. Third, the macro divergences with key historical comparisons, and the concern I have with everyone being on the same side of the trade right now. Fourth, sentiment and the degree of margin and leverage now being used on what I believe will turn out to be false hope. I need to stress that despite rather negative observations, you need to study the charts in the report itself to see how we expect this to play out as the central banks move towards what I call OPMF, or overt permanent money financing, which is the new buzzword for the global banking cartel, as they roll this out, which will have significant impacts on the market. And that doesn't mean that it's actually connected directly with some of the things that I'm going to show you this morning. Starting with economics, downward revisions to previously hopeful levels for Goldman's Global Leading Indicator, or the GLI, suggests a significantly softer patch for global activity consistent with subdued growth in the near term. The GLI has now been in slowdown phase for 4 consecutive months, and while it has not reached the contraction phase yet, empirical results show this phase far less supportive of risk assets than the current exuberance suggests, with Korean exports, global PMIs, and industrial metals all disappointing. The most concerning aspect is Goldman's 3 key risks: U.S. growth, Euro risk, and China growth. They have all upticked significantly in recent weeks after consistently falling all year. As the swirlogram indicates, the slowdown is deepening. And at the same time, the big 3 risks are coming back to life once again. But U.S. stocks are outperforming their typical slowdown phase performance, even as emerging market stocks, world growth stocks, oil and copper all drastically underperform. The market is beyond overstretched at this point on a short-term, intermediate-term, and frankly long-term basis. The sheer number of warning signals is simply staggering. The blow-off top out of the rising wedge pattern we can see here is indicating this is likely really a false breakout. The Russell 2000 shown on the right is lagging well behind the S&P 500. Small caps in general should lead a rally if it's going to prove legit. On the left here, China, which has led the S&P in general since the 2009 bottom, peaked months ago. On the right, copper, which serves as an excellent proxy for the global economy and is referred to because of that as Dr. Copper, is collapsing, showing that this rally in stocks is occurring while the global economy gets weaker and weaker. The U.S. macro has absolutely plummeted as a consequence, with little reaction from the equity markets. We will show some historical comparisons that are very telling. We just had a terrible ISM services and factory orders to add to this mix. With macro data becoming worse and worse, which is more and more bullish for Fed free money, and stocks off to the races, despite earnings that are abysmal, we thought a little reminder of just what is driving this unreality in nominal price moves was in order. As this chart, inspired by UBS, shows, each time the S&P 500 shows any sign of weakness, U.S. money grows dramatically, where money is defined as the sum of M2 and foreign custody repoable holdings at the Fed. Simply put, this is the reaction function of the Bernanke put and explains why any weakness in Europe causes problems for the U.S., as the foreign banks repatriate and impact this growth support. Correlation is not causation, but it is a strong hint. The growth in money, M2, plus the New York Fed's foreign official institutions' custodial holdings of treasuries and agency debt, i.e. repoable stuff, surges, red-green arrows on inverted axis, each time the S&P 500 shows any sign of stalling, the red arrows, which is the exact opposite of the relationship in the pre-Lehman charts. The fact is that the strongest leading indicators, as well as the most timely coincident data, have deteriorated and danced along the border between economic expansion and economic recession for more than 2 years. Meanwhile, repeated rounds of quantitative easing have produced little but short-lived bounces to defer a recession that historically would have followed such deterioration more quickly. This chart offers a good picture of this process. For a while there, it seemed that even the densest of career economists who try to pass for stock pundits on financial comedy TV were starting to understand that without the Fed's, that is, the ECB and the Bank of England's and the Bank of Japan's quantitative easing, the market would be much, much lower, whether 500 points lower, as Gundlach recently suggested, or much more remains unclear, though I show here a pretty good cut at that. After all, by now it should have been clear to most that quantitative easing is doing nothing for the economy and everything for the stock and bond markets. Here we certainly agree there is a bond bubble, which by implication there is an even more massive stock bubble too. Anyone who says the two are unlinked can be immediately put on mute. And yet, judging by the roster of TV guests appearing on assorted cable stations, the confusion is back again. So just to set the record straight and make it so easy, even Jeremy Siegel gets it. This is a chart showing the absolute performance of the S&P starting with March 18, 2009, when full-blown quantitative easing 1 was announced, and adding up all of the S&P points gained under some QE regime, whether QE1 from 2009 to 2010, QE2 from 2010 to 2011, Operation Twist, QE3, and QE4 from 2011 until today, on one hand, while subtracting all the S&P's points lost when there was no QE or no advance notification of QE from the Fed, such as the period from the end of QE1, that was March 31, 2010, until the QE2 announcement at Jackson Hole in August 2010, and from the end of QE2 on June 30, 2011, until the start of Operation Twist on September 21, 2011, we get the net. The chart is sufficiently self-explanatory that not even career economists will need assistance to grasp it here. Switching gears to fundamentals in the long term, Q1 earnings, we have long commented on the hockey stick-like expectations of second half 2013 resurgence in earnings per share and revenue growth. This miracle waiting to happen is sadly increasingly unlikely. As Goldman Sachs notes, the S&P bottom-up consensus earnings per share estimate for the remainder of 2013 has fallen 1% since the start of the earnings season. Revisions have been most negative in the materials, down negative 4.1%, and information technology, down 3.7% in those respective sectors. Managements are guiding well below consensus estimates. Of the companies having provided Q2 guidance, 76% guide it with a midpoint below the mean consensus estimate versus an average of about 69% over the past 28 quarters. The median firm guided 4% below consensus versus 3% historically. However, since the start of the earnings season, bottom-up consensus full year 2013 estimates are down only 40 basis points, suggesting analysts and serial extrapolators alike have considerable more reality to catch up to yet. But for now, hope is fading a little with earnings per share, sales, and margin expectations for the rest of the year all being marked down. It seems the hockey stick is starting to droop here, most notably in materials, technology, and industrials. According to the media hype, stocks are never expensive. But if you care a little about the actual price you are paying for stocks, perhaps the following two charts will at least raise a doubt about chasing this fun and games. The prospective PE on both U.S. and non-U.S. equities are now at the top of the post-crash range. Multiple expansion has driven the rally in large part on the basis that central banks have removed the downside tail to investing, but at these valuations and with expectations that are still priced in for second half of 2013 earnings up 14% versus up 4% in first half, surely caution is warranted. Shown here are earnings per share growth consensus expectations for the S&P 500 for the rest of the year. And based on this hockey stick, here is the forward PE for the United States and non-U.S. equities. Revenues and margins. First, the good news. So far, of the 252 companies reporting Q1 earnings, 74% have beat expectations on the bottom line. In Europe, it's a different story, with 44% beating and 56% missing. The reason, progressively lowering of estimates for the past 3 months heading into earnings, and we've shown this many times before, this behavioral pattern. On the top line, it's a different matter entirely, with just 45% of companies beating and 55% missing. Indicatively, European revenue numbers are just jarring, with only 34% of companies beating top-line estimates. That's what happens when you have a depression. None of this should surprise any of our listeners. Over a year ago, we talked about this and what was going on, and explained that instead of investing in CapEx, that is, capital investments and hiring, due to the Fed's imbecilic endless ZERP policy, companies have scrambled to generate immediate returns for shareholders in the form of dividends, buybacks, and in rare instances, mergers and acquisitions. Investing in long-term growth is the last thing on anyone's mind, and sure enough, eventually, revenues are deteriorating the world over. It was only a matter of time. All of the above is summarized in the table here, courtesy of Deutsche Bank. Now the bad news. While one can easily game expectations and quietly cut forecasts the night before earnings just to allow the company to beat them easier, one thing that cannot be fudged are trends in time, in either revenues or earnings per share, and for the best tables showing just how ugly corporate America's profitability and revenues have become when stripped of all the noise, we go to the Wall Street Journal and the following summary of year-over-year changes in sales and earnings per share. They do terrible analysis, but, when it's really simple and really obvious, they usually get it. With earnings reports in from more than half the companies in the Standard & Poor's 500 stock index, first quarter revenues for the group is expected to shrink 0.3% from a year earlier, according to Thomson Reuters. That would cut short the sales improvement record reported at the end of last year and mark the third quarter out of the past 4 in which revenues have failed to grow by 1% or more. The sales figures are a troubling sign that businesses and consumer demand remain weak nearly 4 years after the recession. They are also evidence that a soft patch is developing in the U.S. economy, as optimism earlier in the year gives way to more sobering data on growth in gross domestic product, retail sales, and manufacturing. In response, many companies are cutting jobs and curbing investments in an effort to prop up profits, moves that could make it harder for demand to recover. They're getting squeezed again. No further commentary is really necessary. We've said this all before. From Goldman's weekly Kickstart note, a great breakdown of S&P earnings so far. categorized by sector, showing which have been beating on earnings and revenues and which have come up short. The real insight here is in the surprise columns for both earnings and revenue. As you can see, if you look closely, 42% of companies have had a positive earnings surprise. Just 19% have had a positive revenue surprise, meaning companies are, once again, doing much better squeezing out productivity and keeping wages down than they are at growing the top line, that is, growing the business. This is because, as I said, they've cut CapEx. If you don't invest in growth and you don't invest in productivity, it eventually dries up on you. This has been the trend for a while now, leading to record high corporate profit margins, which some view as unsustainable, but now they're holding on. Both the levels and growth rates of the S&P 500 revenues and U.S. nominal exports are highly correlated. Nominal exports remained in a volatile flat trend during the first 2 months of the first quarter. This might be one reason why revenues have been lower than expected during the first quarter earnings season. Of the 270 S&P companies that have reported, 56% have negative revenue surprises. Nevertheless, analyst consensus revenue estimates are holding up surprisingly well for this year and next year, with gains of 3% and 4.6% respectively. S&P 500 profit margin estimates are also holding up, with 9.8% expected this year and 10.5% expected next year. People like Ed Yardeni still expect margins to remain flat in 2013 and 2014, so earnings should grow at the same pace as revenues. For earnings, Yardeni is predicting $110 per share this year, up 5.9% year over year, and $118 next year, up 7.3%. Obviously, he is more optimistic about the prospects for revenues than the analysts. However, because the analysts are more optimistic on margins, where they're currently predicting that earnings will be 111 and 124 this year and next year. I personally don't buy any of this, but I need to point it out, and specifically what others are saying, just so that we're balanced on these tapes. I want to start now with risk and a technical chart. Record high corporate profit margins have allowed corporate America to maintain profit growth even as revenue growth has stagnated. Some, like John Hussman, warn that these margins will inevitably have to revert to a mean. However, there are many who believe these high profit margins are sustainable and could actually rise further. In his latest note to his clients, Citi's Tobias Levakovich points to one structural aspect of profit margins that often goes overlooked by the bears. From his note, and I quote here, "A peak in corporate margins has been forecast by several market observers for much of the past 2 years, even as the components of those S&P 500 margins tell a somewhat different tale. Essentially, profitability corrections typically are tied to economic recessions, as fixed overhead costs are underabsorbed in the economy, often because companies cannot reduce employment staff as quickly. But the real mistaken view comes from misunderstanding the overall margin environment when removing the tech sector's influence. If one looks at margins X technology, it is easy to recognize that margins were higher elsewhere for years before 2008-2009 downturn, and there is still upside to most other S&P sectors' profit opportunity. The bears tend to look at margins more from a top-down big picture perspective. Of course, corporate America as a whole will not be able to squeeze out profits like this forever. However, the warnings of imminent doom are a bit overstated." End of quote. This is what Tobias is reminding us of, and he's got a valid observation there. We know exactly what will happen should the market overwhelm the money briefly or more permanently. And for your information, the break point in mid-2006 between the macro reality and the markets coincided with Magnetar selling collateralized debt obligations guaranteed to fail, Merrill CDO department's difficulties in getting super senior CDO tranches off their books, and AIG and the monolines begin to stop selling CDO protection at the time. One of the things that concerns me is when trades get crowded. Herd mentality, groupthink, safety in numbers, or lemmings. When a trade becomes one-sided, we are often taught that the contrarianism is the smarter position. When a trade becomes extremely one-sided, the market is at its most fragile. There are currently three trades that have become not just consensus, but are near record levels of extreme positioning. And with the help of leverage and record margin levels, this all adds up to a risk-on market since all three trades are on the same side of the long central bank largesse, short safety view. That is, overprone to more significant corrections. Join the crowd or join the smarter money. On the right, but the smart money is hedging. Based on the Bank of America's Merrill Lynch exposure analysis, macro hedge funds continue to add to their shorts in risk assets, including the S&P 500, NASDAQ 100, and commodities. The markets are holding up based on hope for more stimulus from the Fed and the ECB coming. This is a very dangerous environment. We are entering the seasonal period in which stocks typically do poorly, May to November. Earnings guidance is falling, and even the massaged GDP numbers for first quarter 2013 was much lower than expected. In simple terms, we're getting multiple signs that the economy is slowing and heading towards a recessionary territory. This is happening at the precise time that stocks are holding up on hopes of more stimulus. The rising bearish wedge pattern in the S&P 500 that we've been noting remains in play. It should be resolved near term. However, multiple economic bellwethers are already warning danger, danger, danger. Here is a price performance chart for the S&P 500 against FedEx, postage and shipping, ArcelorMittal steel, and Caterpillar machinery. As you can see, the real economy is falling, but stocks keep holding up. Nowhere is the total lack of concern about downside risk any more evident than in the distribution of returns that the options market currently implies for the S&P 500. The chart here shows an extreme perspective that downside risk is being priced out of options prices to the same extent as it was in the previous bubble peak in 2006. As opposed to VIX, which merely tracks the perspective of market participants about volatility, two-sided risk, the chart here is a pure measure of downside risk and shows that complacency is at an all-time high. Things in the economy, I guess, must be good. Investors nearing their most levered long to U.S. equities ever. As Sean Corrigan notes, net margins, defined as the New York Stock Exchange margin debt minus mutual fund liquid assets, is within a hair of its all-time record high, and relative to the March 2000 peak in the Wilshire 5000, that is the broadest U.S. equity market cap, we are rapidly approaching peak exuberance levels. Indicatively, this should make sense since the market is at all-time highs, but it is so because of central banks, not because of individual investors. So why would the investors themselves be just as stretched as the global central banks, and how does this leverage upon leverage unwind in the end? Current levels of both net free credits and margin debt indicate extremely bullish sentiment in the equity markets. The implication is contrarian bearish. This is a fantastic chart, and the data here from Citi Research showing the issuance of various securities over the last 10 years in the Eurozone, US, and Japan. It is interesting to note the surge in the treasuries that has occurred since the collapse of the GSEs and the so-called AAA bubble in real estate. It's also interesting to note the decline in net issuances. In other words, the supply of asset issuance continues to run at levels well below pre-crisis levels. That might explain at least some of the broad upward pressure on assets in general. The blue-gray bars quantify the net issuances of securities across broad asset classes on a rolling four-quarter basis in the Eurozone, the US, and Japan. The orange bars capture the effects of the central bank's interventions. The red line is the net amount of issuances left after those interventions. In other words, it is a proxy for the change in the size of the universe of securities that investors can buy. As you would expect, the chart shows the surge in net government debt issuances in 09-10 as fiscal deficits balloon. These have fallen back over the last couple of years, but remain significantly higher than before the crisis. The surge in corporate issuances of bonds since 2007 is perhaps less intuitive, considering that companies have generally run their balance sheets very conservatively, cutting capex and M&A. However, a big shift from loan to bond funding has more than compensated for that. Net equity issuances remains a relatively small component. That is really telling. Pay attention to that. Net equity issuances have just disappeared. Equity is shrinking. There was a brief flurry of equity issues in 09-10, but as leverage has come down, corporates have reverted to the more normal pattern of retiring shares on a net basis. The biggest shift has been the drop in net issues from financials and GSEs like Fannie and Freddie. Having dominated securities markets before the crisis, their net issuances has dwindled to next to nothing in recent years. Adding up the bars, still ignoring central bank interventions in orange, shows that the growth in the investable universe has slowed from around 3.5 to 4 trillion annually before the crisis to less than 2.5 trillion over the last couple of years. In other words, the rate of expansion of financial securities has slowed by more than $1 trillion. That's a lot of money. When the effect of central bank interventions, quantitative easings, and LITRO 3 in orange is subtracted, the reduction in supply of new assets available to finance investors becomes even more dramatic. Apart from the brief period in first half 2011, where markets incidentally did not perform particularly well, the investable universe of financial assets has grown by less than 2 trillion per year over the last 3 years, half the run rate that we're used to. In fact, in some quarters, net issuance of securities have been virtually zero. I think that this supply effect on financial markets of central bank interventions is really widely underestimated and is critically important, and we show this in the report and why our projections of what we see with the market between now and September, and then between September and year end, and then 2014 can vary with some of the macro views that we've been discussing. In closing, I'd like to take a moment just as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2013 be an outstanding investment year for you. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.